Um, Good morning once again. Welcome to the Ag Economic Dialogues. Tong is going to start the presentations today. I'm going to let her share her screen and introduce herself and her presentation.
Okay,
If you have
thank you.
questions and concerns, I'll be monitoring the chat.
Okay, so my presentation today would be to utilize precision livestock farming technologies in the beef cattle production. So my name is Tong Wang. I'm an advanced production specialist in South Dakota State University. So first of all, I would like to show you some trends of challenges in the current beef cattle production. So we know that in the modern beef industry, the beef cattle have evolved towards the large herds and operations, so fewer operations. During the past decades, we see the number of beef cattle operations in the United States have decreased by about 15%, but the number of beef cows have increased by 6%. Therefore, for those large herds, the traditional reliance on observational skills and hands-on experiences is perhaps not sufficient for effective management. So in this situation, there has been some challenges in the modern beef cattle industry. So there has been some needs for better solutions. And precision livestock farming has been showing up as a possible solution here because over the past 2 decades, there has been some significant advancement in technologies which contribute to the precision livestock farming or PLF development. So PLF enables real-time tracking and analysis of individual farmers' behavior, performance, and environmental impacts. So those advancements have basically revolutionized the way farmers monitor and manage their livestock. So I break down the precision livestock farming technologies into 4 categories, and I will go over each of them. So the first one is livestock movement tracking and controlling. The second is livestock performance monitoring. The third one is feed and grazing management. And then lastly comes the environmental impact monitoring. So under the livestock movement and tracking and controlling, we have a combination of virtual fencing and GPS-enabled collars. As you can see from here, this collar here has become commercially available, which allowed producers to control livestock grazing without physical fences. So when cattle approach their designated boundary, the collar here will emit the audible cues and so prevent the cattle from crossing the boundary. However, if the cattle continue to cross, they will receive some harmless electric shock. And this innovative approach actually can support rotational grazing without a physical fence. And it actually comes with multiple advantages at the same time, including the reduced labor costs and adaptation to the challenging landscapes, and excluding the cattle from those dangerous zones and wildlife habitats and prevent the cattle from overgrazing the grassland. And besides the movement, we have the livestock performance monitoring, so in which we utilize sensors to collect data on parameters such as body temperature, heart rate, and feeding behavior. So those innovations can help detect the potential diseases, health disorders, and breeding abnormalities and heat stress. And we have innovation in the daily precision weighing systems as well, such as the walkover weighing platforms, which enable farmers to closely monitor animal performance, growth, and body weight gain. Next comes the feed and grazing management technologies. So those PLF technologies relate to the forage management, such as precision monitoring of the forage quality and quantity, forage species, composition, soil moisture. They help farmers estimate the forage availability, nutrition value, and to adjust stocking rates accordingly. So such type of information about forage intake supports precision feeding and optimize the feed supplementation and ensures a balanced diet for livestock. And we also have the daily water monitoring, which provides information on the animal water intake and also facilitate effective management of the water usage. So lastly, we have environmental impact monitoring. So such technologies also employ sensors to monitor and measure the methane concentrations. So the concentration of methane can differ based on those factors such as feed composition, quantity, animal species, manure management, and climate conditions. So the data obtained from sensors can facilitate strategies to reduce livestock emissions, including the dietary adjustments and implementing effective manure management practices. So to understand how farmers use and how they are aware of those technologies, so we conducted a survey. So the survey was conducted about 3 years ago during the first quarter of 2022. So we conducted the survey in 3 states, North Dakota, South Dakota, and Texas. So we sent out about 781 survey samples and received more than 300 with a response rate of 43%. For the respondents, they were asked about their awareness and adoption status of 12 PLF technologies, and we grouped into 4 categories. So for each of them, we asked their awareness, current adoption, and future adoption likelihood. So this is a table so where we have the results grouped into 4 categories: animal movement, livestock performance, environment, and feeding grazing management. So these are some standard technologies under each of the category. For example, under the animal movement, we have virtual fencing, animal location tracking, and then livestock performance, we have health tracking, breeding monitoring, and performance monitoring. And then under the environment, we have greenhouse gas emission monitoring, and under feed and grazing management, we have something like daily water monitoring, precision mineral supplementation, forage supplementation, monitoring of forage quality and quantity, and forage species and composition, and soil moisture. And then I look at the awareness rate and adoption rate for each of the technologies. And we found that for the awareness rate is pretty high, about 2/3 or more than 2/3, and slightly less than 2/3 of farmers they are aware of those technologies. So the awareness rate shows less variation across different technologies. So about from this 59% to 71%. So very close. And then we look at adoption rate. So we found the adoption rate actually varies a lot. So from this less than 1% from the greenhouse gas emission monitoring, which is less than 1%, and to nearly 20%, which is the precision mineral supplementation. So we see that if we rank them, so I have 1, 2, 3, 4, which those highly ranked 4 technologies, we can see if we look at this feed and grazing management, they are all fall under the feed and grazing management category. And then we see that if we look at the animal movement, which has been promoted, quite often recently. However, that 3 years ago, the adoption rate is quite low. It's just slightly over 3%. Of course, the lowest one comes to the environment because it may not directly relate to the farmer's profit. And so we see that even though there's no difference, quite much difference in ranking of the awareness rate, but the ranking of the adoption rate has been, the top ranking ones more focused on the feeding and grazing management categories. So what we observed is only 1/3 of the 12 listed PLF technologies adoption rate of more than 10%. And we found that the top 4 most adopted PLF technologies, they all belong to the feed and grass management category. And adoption rate of the most adopted PLF technology is the precision mineral supplementation. Even that is less than 20%. So which showing we have a long way to go under this PLF technology promotion. So awareness rate, we can say that awareness rate is much higher than the adoption rate and with the lower differences in between. So it ranges from 59% to 72%. So which indicate that while most livestock producers, they have heard about PLF technologies, maybe they are hesitating or they prefer some of the technologies over others. And we look at the future adoption likelihood indexes. So we found that for the person who are aware of technology, we further ask, are you going to adopt? Are you not going to adopt? So for those aware and may consider adoption, so the percentage is listed here, and where we are not adopt, we list their percentage here. And we further develop an index based on the people's desire, either to consider adoption or not to consider adoption. So we use the percentage of people who consider adoption divided by the percentage of the people who will not consider adoption. So this generates an index. So if you look at this index, if it's greater than 1, that means people who consider adoption will be more than people who will not consider adoption. So that shows a higher perspective for future adoption. So we look at the index is greater than 1, so the highest future adoption technologies, we rank them. Again, we found those belong to the feed management category. So which shows that both the current technologies adoption rate or the future adoption likelihood, the farmers prefer the feed management technology over the other categories, at least from what we observed in the survey. So as we just mentioned, we have the adoption likelihood index, which represent the future adoption trends of PLF technology. And those index to a large degree actually mirror the current adoption rates. And we have the top 4 adoption likelihood indexes, which are greater than 1, all again fall under the feed and grass management category, just like the current adoption rates. Okay, so about the conclusions and the implications, overall, we find the adoption rates of PLF technologies are rather low, and some technologies are preferred over others. So we found technologies in the feed and grazing management category have much higher adoption rates and more likely to be adopted in the future. In contrast, we found the GHG emission monitoring have less than 1% adoption rate, and the prospect for future adoption is also the lowest. Very few producers we found have adopted virtual fencing, and the intent for future adoption, we found they are also weak. And we found that based on our results, so if we want to promote the PLF technology to more farmers in different forms, we need to provide support in technical or monetary forms for those technologies that may not translate to direct profitability in the short term, such as the GHG greenhouse gas emission technologies. Okay, so that's the end of my presentation. Thank you, and you can find my contact information, and if you have questions, let me know, and you can also email me afterwards. Thank you.
Are there any quick clarification questions for Tong? Going once, going twice. Okay. Tong, if you'd stop sharing your screen, bring up mine. There'll be time later for more questions if something comes up too. Tong, will you confirm that you can see my slide deck correctly?
Yes, I can see.
All right. Thank you. I'll be visiting a little bit today about some commodity marketing tools. Some of these are things we sort of explored during a commodity trading class this last spring semester, and some are emerging sort of tools or newer things that are being promoted by the Chicago Mercantile Exchange Group, the CME Group. So we'll just take a look at some of these different tools out there, and we'll look at short-dated new crop micros and some fertilizer. There's been a sort of a prolific. There's been more contracts listed for more months, somewhat parsed out by expiration dates. There's also different sizes of contracts in a lot of cases. And some of these are geared towards a retail market. So what would a retail market look like? That would be predominantly non-hedgers. So perhaps small speculators, individuals who just want some exposure to different things. But sometimes some of these same tools might have an indirect or a hedging application. So even though some of these things I'll be talking about are geared towards, say, a small speculator, we'll see if there's a use for them. The three categories I'll focus on are the short-dated new crop options. These are available predominantly on corn and soybeans, and looking at them right now because they sort of one of their last big uses is positioning for corn and soybeans ahead of the acreage report later this month. So that's sort of why we're taking a look at it right now. And then we'll look at minis and micros, and I'm going to use a hog crush as an example, just as a way I've thought about and thought how to think about minis and micros. And then we're going to look at fertilizer a little bit. So we'll start with short dated new crop options. So it's a mouthful. What is a short dated new crop option? Well, these are puts and calls that expire at the end of calendar months, usually before or during the growing season, and they're based on the settlement or tied to specifically new crop futures. So corn, we're talking about options that expire at different times against the settlement of December corn. And for soybeans, you're looking at options that expire throughout the calendar year, tied to what the ending price is at expiration for the November soybean contract. Now, for most of these short dated new crop options, they settle on the Friday before the second to the last business day of the month. I have no idea why, but what it means is that even though there's a Friday still coming in June, there's not 2 business days afterwards. So the June 20th today is an expiration date, of course, for the July short dated new crop option. So at the end of the day today, whatever December corn settles at or November beans settles at, that will dictate whether or not an option that expires today on that contract, a short dated new crop option, is either going to be in the money or out of the money. If it's in the money, then it can automatically execute and convert and turn into a futures contract. So if you buy a put option, you buy the right to sell futures. And if that has in the money at the end of the day, it will automatically execute, and you will, instead of owning a put option, you will have sold a futures contract. And that's what you would do if you were hedging. You would sell new crop corn, for example, and hedge those bushels. So it works, and they're just becoming more popular. So why would you look at those? Well, they reflect substantially less time value compared to standard options. So if there's the next one to expire will be in July 25th. July 25th is the earliest new crop option standard expiration date that's passed or after the June acreage and stocks reports, which come out at the very end of the month. So you need to have a date after those events to capture or pick up the movement in futures prices. So that's where we're looking at the July, focusing mainly on the July contract the July expiration, which would technically be the August new crop option. So it expires after the acreage report, and buying an option with only, say, 30 to 40 days of duration or lifespan to it is going to cost a lot less than buying a regular option on new crop, which would have, say, about 150 to 170 days until it expires. So less time value means less of an outlay, lower outlay, less capital, less financial capital, or less cost to get it. Doing or looking at the short dated new crops, you might be looking at a time where you're including or excluding some of the relatively volatile periods. We'll take a look at a couple of pictures or charts that sort of show that a little bit more than we might otherwise see. Make sure I'm not missing anything here. So why would you use these, or how might they be used? They may have a role to step in some sales, get some sales made but ahead of the acreage report, or if you didn't meet your objective and you had the option in place, it automatically puts you into a futures position at that time if the market's moved relative to where you wanted it. So it might have some use there. And oddly enough, this was on the CME group site. They talked about using calls. So you've hedged, you've used the futures contract, and buying a call option to be a way to re-own on paper if the report moves against you, for example. Let's take a look first at corn. So here are the last 15 years or so of new crop December corn futures prices from a year out from expiration. So early last week, I took the snapshot here. You see that we've got this, get a little laser pointer here. Right in this area here is the 2025 December new crop futures price. So it was running around 440-ish. That we're looking at what would happen between now and the final expiration time out here. So if we look at other years, you've got years where there's large price declines or large price increases at different times between now and very late in the harvest period. At the very late in the harvest period time, it tends to be a little quieter, depending on the year. So the short dated new crops are giving you snapshots. So the July 20th would say, what if you wanted to draw a line in the sand vertically right here and take an option position and only be managing the risk between now and that option's expiration time. So that's what the spatially what the short dated new crop is looking like. On the soybeans, here's just a different snapshot of volatility in the soybeans. So again, let me grab a laser here to highlight just a couple of things. This is different strike prices going back and forth like this. So amount of moneyness in the money, at the money, out of the money. And then these are the contracts. These are regular contracts from the July out through new crop, December 25, and then included all the way out to new crop, November of 26. So what happens during the growing season tend to have a little more volatility or movement in prices, and that's reflected along the pattern here in the back. You can see if you just superimpose this on the level of volatility through or across contracts, you'll see that the volatility is expected to be fairly low in the very short run, and then it sort of peaks here at around 18% before tapering off. So there's a volatile period between now and November when the regular option would go off the board, reflecting the summertime volatility or growing season volatility in prices. The short dated new crops parse that out slightly differently, but it still picks up expected price fluctuations during those chunks of the growing season and it all ends well before harvest time. So it's another way to look at it. And I've got one more chart in a few slides that shows this. Not the overlaying of the regulars, but an overlay of the short dateds for comparison. Are people using short dated new crop options? Short answer on corn and soybeans, yes. So this is an overlay of the regular option. This was last week, so there was 162 days until the regular December new crop corn option would expire or go off the board. So there was at that time about 450,000 puts and calls of open interest across all strike prices. I'm only showing a handful of strike prices here, but across all strike prices, 450,000 new crop options were open as of last week. The short dateds are shown to the left. So we've got the last week, there was still 8 days to go until the contract that expires today. The July short dated new crop would go off the board. And you can see that the with 1 week out, or sorry, when it's the nearest nearby short dated trades in 1 cent increments, and the rest of them trade in 5 cent increments. So you've got 430s and 435s. There were no 432s listed last week for the August short dated new crop. All open interest across all the short dated new crops that expire against the 2025 futures contract totaled 205,000 contracts last week. So if you think about it, you've got options that span about half the remaining time between now and when the regular options would go off the board, and you have about half the open interest reflected in short dated new crops relative to the regular options in terms of total open interest on the contract. So yes, I would say they have some popularity and they are being used at least somewhat to manage around things like major reports and such. What would it look like in terms of a premium? So last week, I went into the CME. I have a login identification, which is free for anyone to obtain, and that lets you get behind the scenes on the CME Group website for some of their additional tools. So here is the option calculator, or the option pricing quick tool. That so all this is just screenshots from that quick tool on the CME. And I've got a comparison here of, so last week, if we'd start up here at the top, you've got the regular option, the regular new crop corn option. So it would expire at that time at about 160 days from expiration. I just grabbed an at the money put option. So regular price protection at the money put would have cost about 25 cents a bushel last week for a slightly out of the money 440 strike put. So what would that mean if you only had to buy? So I threw in 144 days. So if we just fast forward a month, you're getting a little bit of time value, or the time value doesn't cost a whole lot to go from 160 days to 144 days. You drop the price from 25 cents down to about 23 cents. So just from a straight up risk management perspective, the regular option works fine. It's what you would expect to see. Why would one consider a short dated option? So here I grabbed the August short dated new crop. It has fewer days of life in its entirety. And last week, when I grabbed that, the price for a 440 strike was 21 cents. So a regular option would cost about 25 cents up here, and a short dated new crop in this example would cost 20 cents. It's not a huge cost savings, or bargain. A couple things were happening last week. Just coincidentally, when I grabbed this set of prices, there had been some trades, I think, earlier in the day, and it reflected a very, very unusually high volatility in that particular strike price for that particular option. So most of the other puts and calls at different strikes and whatnot were not trading at 35% volatility, this number right down here, which was much, much, much higher than the 21, 22% volatility reflected in the regular option. So if the volatility had only been 30% instead of 35, that same option, short-dated new crop option, would have only cost 13 cents a bushel instead of 24 cents a bushel. And that too is very high relative to the volatility across other strikes and such. So more typical would be an option that would cost probably closer to 9 or 10 cents for this strike price for this many days to expiration. What that means is you've got some cost advantage to this, but it's not quite as liquid as regular options. And especially ahead of report dates and such, it also is a little bit of demand driven. So other people want this kind of protection in place ahead of something like a report. And if you're, well, I guess just a word of caution, it'd be easy enough to overpay for an option in this situation. And you want to critically understand or look at what you're getting yourself into. You don't need to pay for 35% volatility if other options would be available for at 25% volatility. In fact, you could have gone more in the money and paid less, at least theoretically, compared to the example I grabbed here. So that's out there. How do you get around that? Being well informed, knowing what you're getting yourself into, and then also using limit orders. So you don't want to use a market order and just pay whatever the market is asking. A limit order would be a little more prudent way to get into and out of some of these short dated options. One more picture on these. This is a current snapshot and a week ago snapshot of what happens to the volatility in these markets with very, very short time durations or time horizons. So earlier this week, I took a snapshot from 2 weeks before then, just to show what happens to the volatility pattern as we move through time and then as time passes. So if we look at this really steep set of curves down here, this was what's happened in the last couple of weeks for that option that expires today. So as that expires, the volatility away from at the money gets to be a little more extreme and tends to shift around a little bit. And then if we look at this orange line here, that's the next short dated new crop. So that's going to be the August short dated new crop, which expires in July. That relative to the volatility there, relative to 2 weeks earlier, you can have a little bit of a decline or a shift around in that. And that's typically what we'd see happen before and after something like this might be attributed to a new WASDE report has reduced or changed or shifted the volatility around. So that can happen. And then all four of these options all reflect eventual settlement to December corn at expiration. So where you see the low points on the curves, that's where the volatility is the lowest. That doesn't mean that that's where the futures price is necessarily expected to be. But seeing differences in the low points on these curves says that there's different expectations through time about where prices might be as we go from the nearest to the next to the next to the regular options. So showing when I think the trade would think volatility would be higher or lower. So expecting more volatility until August compared to all the way on average, all the way out to November when the regular option would go off the board. A little too much. All right, shifting gears. A couple other things I wanted to highlight that are sort of newer. Is a very recent introduction is micro contracts. To understand micro contracts on corn, soybeans, and wheat helps to understand the mini contract. The mini has been out for quite a while on corn, beans, and wheat, and sort of still available on Kansas City wheat. A mini contract is 1,000 bushels, so 1/5 of a regular contract. And these tend to have pretty good volume for the nearby contract and often the new crop. So the nearby corn and December corn would have more volume and open interest than some of the other months. The mini might be reasonable for hedgers. Smaller hedger might find a place to hedge 1,000 or 2,000 bushels here or there. The contract itself is technically deliverable. Probably not going to deliver from South Dakota to um, a uh, a river elevator location in Illinois, but technically it would be deliverable. It's also fungible, so if you ended up with 5 contracts, 5 minis, you could offset it with a regular contract. So that's what the fungible means. But these do have a higher per unit transactions cost. So if you're paying the same commissions and fees for a mini, you've got that same cost spread over 1,000 bushels instead of 5,000 bushels. So that is a consideration. Um, the newest contract are micro contracts. They're new here in 2025. In addition to corn, soybeans, and Chicago wheat, they're also available on soybean oil and soybean meal. Now, there's not a mini contract on soybean meal and oil, but there is a micro contract on soybean meal and oil. These contracts are 1/10 the size of the normal contract. So on the corn and soybeans, a 5,000 bushel contract, you're only trading 500 bushels at a time, like a gravity box, I believe. So what's different about this contract? This one was specifically sort of set up, or I think the market motivation behind it was to attract retail traders. So small speculator might be in stocks and bonds and they want some commodity exposure as well. They might be doing something um, with ETFs, but they might also want to look at something on the commodities and adding 500 bushels of corn or soybean oil exposure might be a way to do that. Perhaps. It's interesting. Um, the contract itself, very unlike the mini contract, it's cash settled. So it's not going to be deliverable. And the cash settlement feature means that it expires the same time the short dated new crop options expire. So, sorry, not the short dated new crop, but the same time that options would expire or before the delivery month. So, if you had a new crop corn micro futures contract, its settlement date or expiration date would not be um, in December, but it would be in that late November time period when the regular option on that would expire. So um, it too is just a difference. It shouldn't affect the performance or anything else, but it would introduce a little bit of carry in the micro relative to the mini and or the regular contract. And not sure how to conceptually even think about that, other than just noting the difference and if there was an extreme um, you'd need a big difference between expected carry or lack of carry in a market, which can happen. You see it sometimes with options, when options settle or when options expire. You can have a little bit of a price difference between the eventual futures price and how that ends up settling. So might be something to look at from an academic side of things as well. These do seem a little less practical for any hedging. At the same time, it's the first time you've got something introduced on the soybean oil and soybean meal. And here's one way we thought about this. We looked at the hog crush. What is a hog crush? A hog crush is some combination of lean hog futures and corn and soybean meal. So if you think about buying a feeder pig, adding soybean meal or feeding it soybean meal and corn in a ration, eventually you'll end up with a finished hog or a lean hog. And the standard way to put on a hog crush on the board is to use 8 lean hog contracts, 3 corn contracts, and 1 soybean meal contract. In other words, you need 12 futures positions to put on a hog crush. The standard gross feeding margin in the hog crush would be 2 lean hog, sorry, 2 200 200 weights of lean hogs, less 10 bushels of corn, less 0.075 ton of soybean meal. And how that works is a standard lean hog contract is going to have 200 hogs. 10 bushels of corn fed to 200 hogs would be the equivalent of 2,000 bushels. That would be 2 mini contracts. And then if you had 0.075 ton of soybean meal per hog times 200 hogs, that'd be 15 tons of meal or 1.5 micro contracts. So I was enthusiastic. I thought this would be really slick and really fancy. And it's like, well, instead of buying 12 contracts, you sort of have 1 lean hog contract, 2 minis, and you're still stuck in between with 1.5 or 2. It's hard to trade 1.5. Do you trade 1? Do you trade 2 soybean meal contracts? And then I just gave up and I said, well, why don't we just use 2 of these? And then you sort of have high transactions cost, but a lot less capital tied up with 2 lean hogs, 4 minis, and a partridge and a pair, no, and 3 micro soybean meal contracts. Maybe. So just interesting, something to think about. And it would be a way to conceptually think about how some of the minis and micros might work into something like a cattle crush or the hog crush here, for example. Livestock somewhat have been neglected here. There's been no minis since the Amex days. There is a mid-size milk option still listed. And currently right now, surprise to me, feeder cattle have the largest ag margin. The value of the contract's around $150,000. Margin is over $4,000 for a futures position in feeders. So like a mini feeder cattle or a micro feeder cattle would actually make it accessible for other traders. The feeder contract is currently just a very expensive proposition for hedgers and speculators to be in. LRP, for example, doesn't have is per head, so the smaller minis and micros seem to make some sense there. And we had explored the Bloomberg sub-index futures. There's one for livestock, but still no trading volume there. The last thing I'd take a quick look at is fertilizer. So there's a mini contract on fertilizer. The normal fertilizer contract, urea, out of the Gulf is a 100-ton contract. There's very little price information here, and best I can tell, they're cash settled bilateral trade. So it's not open outcry necessarily. It's buyer and seller work together. And often these are traded in 15 contract blocks. In other words, they fill a barge with fertilizer in New Orleans. So components of that fertilizer contract are used in margin protection. So we just did some math. Caitlin Catan helped me out a little bit with this and ran some numbers. We came up with similar numbers. If you're applying nitrogen at a pound a bushel and you're targeting 150 bushel corn, you'd put on equivalent of 150 pounds of nitrogen, 150 pounds per acre, with 46% nitrogen in urea means about 325 pounds per acre of urea. That means if you're using one regular contract, you'd need to be raising or using it on 615 acres of corn in South Dakota. The 10-ton urea Gulf contract with futures has a more accessible size. You could do 61 and a half acre increments, so it might be a little more accessible. There'd still be basis risk though, and which month to use is kind of an empirical issue as well. But it's kind of interesting and something we've sort of been keeping an eye on because of its use in other areas and just something new and different to consider. Here's my contact information, and I'm gonna be quiet here and stop sharing. It's hard to monitor myself. Are there any questions for myself or Tong, or do we turn off the recording? I'm going to do that. Stop recording.